Hi everyone, in this video we're going to take a look at problem 3.2. So this is the chapter 3 homework, and again, problem 3.2. Okay, so in our class packet here, we've got the problems, instructions, etc. And so it says, given the following information from Yoko's 1231X1, I just put 2021, adjusted trial balance. And we're going to want to prepare financial statements, classified balance sheet, and then record the closing entries. So the first section that we want to work on, if you recall, when it comes to our financial statements, is the income statement. And one thing to note, in your packet you have a whole bunch of listings of numbers and accounts. Essentially, I pulled these in here into my Excel. You won't have this necessarily, but feel free to follow along that way. But you can pull these in off of your work paper. Okay, so the first thing I want to do is just to go through all these accounts with you and kind of parse them out. Where would they belong? Current, liabilities, non-current assets, et cetera, et cetera. So let's do that first. So accounts payable is going to be a current liability. That's usually, accounts payable are usually paid at least monthly, usually weekly. Accounts receivable is a current asset. Hopefully those are usually received weekly or monthly. Accounting revenue, that's just going to be our revenue. Accumulated depreciation. So remember, this is kind of a special account. It's a contra asset account, and that will go along with our plant, property, and equipment, and those are non-current assets. Cash is a current asset. It's kind of the ultimate liquid asset there. Common stock, that's going to be an equity account. Common stock held in IBM. So this is different. The common stock account of equity is what's going to be representative of the ownership in our company. The common stock held in another company, that's going to be an investment, and we're not planning to sell it next year. And so that's a long-term investment, essentially. And so it's a non-current asset. Depreciation expense, that's going to be an expense on our income statement. Dividends are going to be on retained earnings statement. Equipment is one of those pieces of plant, property, and equipment type assets. That's a non-current asset again. Inventory is a current asset. Land held for speculation. So remember to compare that to land used to operate the business. They're both non-current assets, but do keep in mind that the land held for speculation will go with as an investment, whereas the land used to operate the business will be, we'll call it plant assets, plant, property, and equipment, property, plant, and equipment, etc. So, okay, we've got a notes payable here, and when we see notes payable, we have to think about when that note's going to be paid. What is the term date, the termination date, the end date for the note, and the date we have to repay this. And this tells us, and again, if we want to just put some numbers in here instead of X's, which I don't know, the X's always kind of just throw me off a little bit. So I like to put in the numbers, say 8. Okay, so we're at the year ending 12/30/2021. This note payable is saying it will need to be repaid 8/1/2022. So that is within 12, that's 7 months basically after the date of our financial statements here of 12/31/21. And so August 1st, we're going to have to repay. So it's actually going to be a current asset, a current liability, even though it's a notes payable. Because it's going to be repaid within 12 months, we're going to put that as a current liability. If it was going to be paid after 12/31/2022, beyond 12 months, beyond 1 year after the date of the financials, then it would go in non-current liabilities. And sometimes a note payable can have two different portions: the portion that is current that will need to be paid within the next 12 months, and then a portion that's non-current that will need to be paid, after those 12 months, basically. Okay, a note receivable. So we've got a long-term, that'll be a non-current asset because it's, again, farther out than 12 months. Patent will be a non-current asset. That'll be an intangible asset specifically. Prepaid advertising will be a current asset. Rent expense is, just an expense. This is beginning retained earnings. Just for the heck of it, just putting in an actual. That would be retained earnings on day 1 of 2021. And then we'll calculate retained earnings at the end of the year with our retained earnings statement. And we've got an expense. This is a current asset, supplies. Another expense. Not sure why that was italicized, but it's fine. Taxes payable will be a current liability. Typically, it doesn't give us an exact date when this will be paid or anything, but typically taxes are always due, within 12 months at least, each year. So that's always current liability. Trademark will be a non-current, and again, that's a non-current asset, and it's an intangible asset. And unearned revenue will be a current liability. Okay, so we've kind of got just, a listing of all of our classifications, at least, to sort of help us through some of this. So let's start filling out our financial statements then. And I'm just going to link these in. So we got revenue. Well, here's one thing I'm going to do. Let's just do a little Excel work. It's something you might be able to learn here just to help. So I'm going to say this is the account balance, and I'll say category. I'm going to just do that, and then I'm going to highlight this whole listing, and then I'm going to go up here to sort and filter. I'm going to click custom sort, and this will give us the ability to select the category column. So we'll select that, and I want to sort, A to Z. And so now you can see that we have everything basically more grouped together, and that'll help us a little bit as we're going through filling this out, just because it's easier to identify things when they're not so jumbled up. So, okay, so now we can go to our accounting revenue. I guess we're accountants. Is that what it says in here? Accounting revenue. Yeah, okay. So our accounting revenue, and that will equal $500. And then we've got certain expenses, and those are going to be, so we've got all our expenses now relatively easily, grouped so they're not so jumbled. Supplies expense. Okay, I think that was it. We've got a few extra lines in here, but that's okay. And then our totals. And our total expenses here. Or, I'm going to put these down. This in this column. I'm going to use my auto sum. And I'm going to clean this up just a little bit. I'm not going to do that, actually. Sorry. I'll just leave it. Okay, so then we've got net income is just revenues minus expenses. So we have $150 of net income. Oh, am I missing? Let me see something here. I might be missing. Oh, I'm missing depreciation expense. Sorry. Let me throw that in. Let's make sure we grab all that. There we go. Okay. So now we've got all of our expenses. And then again, I'm just to play around with our custom sort. Typically, our expenses are listed by alphabetical order. Now, we don't have headers now. We had headers over here. That was the account, balance, and category. So you can click off this, my data has headers. And then we can go into column B. That's this column here, B. And we'll sort A to Z as well, just so it is. Oh, it didn't work. Oh, shoot. Okay. One thing we got to do first, because it's linking in, and if we sort, it'll actually pick up the wrong thing. So to be able to sort this, first let's highlight all those cells. Let's highlight all of those. We're going to copy, and then paste values. And that'll basically break the links, and now it'll just be standalone information, not linked over to this listing. And then we'll go custom sort. Again, no headers. Then we'll go B, and then we'll go A to Z. And there you go. Now you've got this organized by alphabetical order. The reason that didn't work before is because it was linking over here, and when you sorted it, it started picking up the wrong accounts essentially because the links sort of went funny. So, okay, so now we've got net income. Let's look at our retained earnings statement. Well, the first thing let's do, just because I like doing this to highlight the fact of why we do the income statement first, let's link in our net income. And then what's our beginning retained earnings here? Let's find our beginning retained earnings, 180. Okay, our subtotal, we're going to add our net income to our beginning retained earnings. And then we're going to subtract out our dividends, which are 25. And the 310 plus, the negative 25 gets us to 285 ending balance in retained earnings. And then again, we're going to link up to the ending retained earnings there. So I just like to link that because it shows you, okay, we need to do this net income, then retained earnings statement, now the balance sheet. Okay, now let's look through our classified balance sheet here. So you've got all your current assets basically organized. And so that's easy to select from. And remember, we picked these in order of liquidity. So cash will go first, accounts receivable, inventory, prepaids, and supplies. Always cash is first, and AR is basically always second. And then it gets a little bit less clear in terms of what's more liquid as you go down, but inventory, prepaids, and supplies is a good breakdown. So, okay, so then check this out. I'm going to teach you a little bit of a trick while we're doing accounting tricks here. So I've got these listed in here. Again, I'm going to break these links. I'm going to copy and paste values just to now have those values as they are so they don't change if we do any links, because I kind of want to play around with this thing a little bit. But here's something I want you to check this out. This is called a VLOOKUP. So you type in the formula equals VLOOKUP. And what we're going to do is we're going to basically make a formula that's going to look at what's in this column, and then it's going to look at all this stuff, and it's going to find the same word like cash here, and it's going to pick up automatically the amount that's to the right of it, essentially. So it'll be a kind of a cool little formula that's a pretty important one to use. So let's practice with that, because this is a good opportunity to use it. Okay, so we're going to first type in VLOOKUP, and then our lookup value is this. In this instance, it's cash, and we'll drag it down, and it will pick up these other ones, and then put a comma. Our table array, this is our whole table here that we want to pick from. So we're going to select that whole thing. You could pick up the headers too, it's okay. And now this shows us H3 to J28, that's all those cells. We want that to stay the table as we drag this down. So hit F4, which puts in $ all around this, and that makes it like lock in. So as we drag the formula down, that won't change. That's important. Okay, and then another comma, and we're going to put in 2, because how this works is it's going to pick up the first row, and then it's going to say, what's the second? This is number 1 where it looks first. This is 2. This is 3. So we want the formula to say, look at this thing, check this, first column for what the term is. If it finds it, we're going to say pull in the second value. If we said 3, if it had cash, it would pull in current asset, but we're saying 2, so hopefully it'll pull in 40. And then we want to type in false, which means it's just an exact match, essentially, is how that works. So voila, and then it picks that up, and then we can basically just drag this down. And then you can see, so that accounts receivable is now pulling in the 20, inventory is pulling in the 25, prepaid advertising is pulling in 40, and supplies is pulling in 15. And you know what, as I'm thinking about this, I will leave this in Excel for you all to follow along with and not have to use just the paper formula, because actually like this is the VLOOKUP is a really useful tool. It's used quite a bit, so I think it's fun. I think it's a good idea to practice with that. So yeah, so there you go. That's how that works. It's a really powerful tool. Just to, if you have a listing, you don't have to have them in order, and because otherwise, if you just drag this, for example, if you said, cash is 40, and then you just drag that down without a VLOOKUP, it's just going to pick up the next number down, 25, 40, 15. But those aren't what you want. You want these amounts, even though they're not perfectly in order up here. So that's just going to pick those up. So very cool formula. And yes, let's do an auto sum. So that's our total assets there. One little formatting thing, let's get rid of these dollar signs. So let's hit our form accounting and then get rid of the extra decimal places. But then let's add it back here. And so that's currency, or sorry, it's not currency. It's accounting, just like that. So a lot of times how the formatting goes with these kind of reports is dollar sign at the top and dollar sign at the bottom. But you don't need it in the middle. Makes it a little more clean. Okay, so now let's look at our plant assets, so non-current. And land used to operate the business is one. Equipment, again, liquidity is first. So, the longer lived assets will be on the bottom, let's say. So we've got equipment, and I'm just going to copy, right click, paste value, just to avoid doing the copy paste values later. We've got equipment, and then we've got land used to operate the business. So let's copy that, paste values. And then we've got, what's our last one? Accumulated depreciation equipment. Okay. And let's do this. And now what's cool about the VLOOKUP, because it's going to continue to pull from this table, is we can just go back. I'm going to pick the top one because it has the formatting I like there. I'm going to just Control C. I'm going to go here and Control V. And again, that's going to now pick up, since we pasted it down, this is going to pick up from here. Because we put those dollar signs, it's still just keeping our table, and it automatically pulls in the value that's to the second, this is with our VLOOKUP table, this is 1. You don't need to put these in, but just for reference purposes, this is 1. It pulls in 2 because we put 2 in our formula right here. See that? And if we put 3, I'll just, for the heck of it, you see how it picks up current asset? That's because that's the third value. See how that changed down there? Let's undo that and pick up the second. So the really cool thing is, yeah, once we have this, let's just set this whole thing up, and then let's just go through and knock this out, and you'll appreciate how quick this is. Especially if you had a really long list, this is where this becomes valuable. Okay, so let's just put all the titles in first. So long-term investments, we had the common stock held in IBM, and I'm actually going to take, yeah, that's fine. That's okay. I was going to take that little parentheses out, but I'm going to leave it. Okay, and then we've got this note receivable. Again, we've lent money that we're going to be paid back on. Notes payable usually is what we see. And then land held for speculation as opposed to land held for operations is going to go there. Intangible assets, we've got a patent. And we've got a trademark. And that should be our total assets, I believe. That's all of our amounts that we have there. And now, okay, so now let's go through, and let's play with our VLOOKUP here. And so now I'm going to copy the VLOOKUP from this because I want that formatting. And so I'm just able to pop that right in. You see how that works? I don't want these decimals. And then I want my little formatting here. My deals there. Okay. And then again, we can take this and just paste this in, and it really helps. The VLOOKUP is great for like making sure you don't have an error. It's better than using just a straight up link or a reference equals this, because like we saw above, sometimes that gets a little wonky if you do some sorting or something like that. But if you sorted these, it should still pick up the right value because it's not dependent. It's just going to be looking at that whole table. Okay, so then we've got our patent. fix our formula there. We don't want to. We just want to calculate the numbers, right? Okay, that's good. Let's sum those. I'm just putting in a little dark bottom border there, bold border, just to make this thing look nice and well cleaned up. Okay, now let's go equals total current assets plus our total plant assets, long-term investments, and total intangible assets. And that gives us, I got 900. Oh, I'm missing something. Let's see. Oh, accumulated depreciation. Be careful on that one. That should be a negative balance, right? So that reduces the value of the equipment, essentially. So there we go, 820. Okay, now we're looking good. And then again, so our current liabilities, we've got those all grouped together here. So we'll go ahead and put the accounts payable. One thing to note with the VLOOKUP, this lookup term, the value here has to be the exact same wording and formatting and everything that is in the table, or else it won't recognize it and pull the right number in. So, okay, that's great. Notes payable. And again, it's current because it's going to be paid within 12 months. Let's see what else we have. Taxes payable. Unearned revenue. I think that's everything. Okay, we've just got an extra little spot there, but that's okay. Actually, if we want to delete that out, I'll just show you there. So if we want to delete this cell because we're not using it, we can highlight it, highlight the two cells, then right-click, delete, and shift cells up, and those will move upwards, and then kind of get rid of the empty space there if we want to make this real nice looking. Okay, now again, let's use our VLOOKUP so we can just paste that around. You can see now it's going to pull from the AP and populate that instantly. I'm just going to take 3 at once and do it that way, right? So those all go up there. Then we're going to auto sum. I want this to be the same formatting. So I'm going to take my format painter and then, oh, it didn't pick up the bold bottom cell there, but that's great. And okay, and now let's just kind of continue through. So we've got our common stock. We do have to be careful. I'm trying to think if there's anywhere that would, no, I think that's okay. Common stock. Retained earnings. Oh, maybe this is the one where we have to be just a little careful. Oh, yeah. So this is just linking up here. So we don't VLOOK up that one because it's just going to be linked. Total equity then, auto sum. I'm going to do this too. So I want these 4 cells to look like these ones just to make my balance sheet kind of consistent with my totals. So that's great. And then let's final moment of truth. Current liabilities, really all we have is current liabilities, but liabilities plus equity equals 820. And again, I want to have this similar formatting for these 4 cells here. So I'm going to use the format painter just to make it nice and clean and consistent. And we can now just do a little check figure. Total liabilities and equity is the same as assets. That gives us a 0. And we can say this is our check figure. And we're looking good. The only little things I'm going to do, just because I like being making this clean, I'm going to use my format painter again. I want to get the $sign on the bottom. And you see how that does not have a $sign there. I'm going to do that again. So now we're looking nice and clean. Very well formatted. So, okay. And yeah, I think that's VLOOKUP is such a valuable tool. It's one you use a lot in actual accounting work when you're dealing with big lists of numbers and things like that, or trying to, it just makes your life a lot easier than kind of hunting and pecking. You could just copy and paste it in, and it immediately populates. So, all right. Well, thanks everybody. That's problem 3.2. And like I said, as I kind of realize the value of practicing with VLOOKUP, I am going to leave the amounts in here so you can follow along and practice with your Excel skills. So. Oh, I almost forgot that in this problem, we actually have to do the closing entries as well. So sorry, I was about to finish up with just doing balance sheet or the financial statements, but let's do our closing entries. And this is I like doing the closing entries related to the financial statements while we're doing those two things, because what you'll be able to see is that the closing entries very closely align with the retained earnings statement, essentially. That's more or less like what we are doing with the retained earnings statement and with the closing entry. So I'm gonna snip a little screenshot of the retained earnings statement and paste it over here with 3.2a. I guess maybe actually I'm going to retitle that 3.2b, because b is the part that says record the closing entries, and I'll leave this as 3.2a. Okay, so what we can see is that, in this we end up with ending retained earnings. And what we're going to do in our closing entries then is essentially the same thing as what's happening here, but with actual, journal entries, basically. So 2021, we're in our general journal, and we're going to use the income summary then to close out our temporary accounts into the income summary. So we're going to do these at the end of the year. So 12/31, December, right at December 31st. And the first thing we're going to close, I'm just going to link these over, is our accounting revenue. If I can find it. Yeah, 500. Oh, geez. Goofed that one up. So our accounting revenue. And remember, I don't want to unindent that. Remember that the accounting revenue in general has a credit normal balance. So it increases with a credit and it decreases with a debit. So we're going to be decreasing the account that's how our closing entry works, decreasing it by the total that was in there before the decrease, and putting that amount. Oh, let me think. How do I want to do this? Sorry, let me start over. I'm going to go up one just because it's formatted already for the entries a bit. So again, accounting revenue, we're going to want to reduce with a debit the revenue by the full amount that's in that account prior to the close. And we're going to use the income summary account. And let's indent this a couple spaces there. And so now accounting revenue is 0, and it'll be open and zeroed out for us to use next month and start, fresh. And then the balance that was in the revenue is now sitting in as temporary income summary account. Okay. Now, again, all of our closing entries are December 31st. Now we're going to close our expenses. And one thing that we can see here is that since right off the bat here, what I always like to do with these closing is you're going to credit your income summary, and then as you go into the expenses, it's opposite, where you're going to be debiting your income summary. So right away, you're going to have the debit for the income summary because we're dealing with expenses now. I'm just going to link these over because that's an easy way to pick those up. That's all of them. Indent those twice. 1, 2, 3, 4. Yeah, we've got 4 expense accounts. So we're going to be crediting the expense accounts. Remember that they increase with the debit, so we're decreasing them with credits to go to 0. And when we're decreasing them, we're just moving them into the income summary. Okay. So now now we've closed out our expenses and revenues. They all have 0 balances. If you were to see a T account, there's no ending balance, and that's what we want, because remember, revenues and expenses are temporary accounts that go to 0 every month, and the balances that are reflected in those only are pertinent to the periods in which we record them, and then they zero out and when we go to the next period every time. Whereas the balance sheet accounts have an ending balance, and those carry over month to month or quarter to quarter, year to year, whatever the period is that we're looking at. Okay, so now we need to close out the income summary into retained earnings. The way I like to do that is I look at the debits and credits for income summary. And the two entries here, we can see credit of 500 and debit of 370, and we want to balance those out to so where the credits equal the debits. And so we can see that we need to debit the income summary. I'm just going to go link that. Oop, undent there. And it's going to be the difference of 500 minus 370. So now you can see the income summary, if you add those two together, sums up to 500. So now our debits and credits equal in the income summary. And that will close out the income summary essentially. And then our other account that we're closing into, I'm going to format paint that, is retained earnings. So here I want to highlight, we're closing into retained earnings. We're increasing retained earnings with a credit through this whole process. And again, that is, let me just do this so y'all can see. That is the 130 there is the 130 here, right? So we're increasing retained earnings 130, and that's what we've done in our retained earnings statement here as well, is increase retained earnings by 130. It had a beginning balance, which we don't see the beginning balance. We'd see that in the ledger, but we're just doing the journal entries. But you can see that we have increased it by 130 there, and then with debits and credits, we've increased it with 130 here as well. And this is the net income, and the net income is the difference between the revenue and the expenses, which is what we're basically representing with the closing entries. Okay, and then the final part of the closing process here is going to be this dividends piece. And so we are going to close our dividends, and dividends have a debit normal balance. It increases with the debit, and so we're going to want to credit the dividends with our closing entry to make it go to zero. Again, close it out and get it fresh, zero balance to start over. And then we've got retained earnings is going to be the account there. And so we can see retained earnings getting credited as an increase, and that's net income. You can see it increasing kind of here, beginning increasing to 310. And then a debit to retained earnings account is a decrease, and you can kind of see how that shows in the retained earnings statement, negative 25. And so that negative that we show in our little report here is the same thing as a debit to retained earnings to reduce it 25 there as well. And again, so if you saw your, just, for illustration purposes, if you were to look at retained earnings T account, for example, if we had a beginning balance of 180, which is what this would kind of represent here, beginning balance, and then let's just follow through the flow of all the things that are happening here on the debits and credits. And so retained earnings got credited 130. You can see that retained earnings credit 130. Then it got debited for 25. And then if we do our little T account, sum up. So if we, what did I do there? Sorry, a little weird side border. Let me do the top border. There we go. So if we sum that side, and then we've got just the 25, and then we take the 310 minus the 25 to give us an ending credit normal balance. You can see the 285, and that agrees to the 285 that we see on our report as well, right? These aren't, they are, this is just the reports, and in the reports, like the financial statements don't show it in like a debit and credit format. They show it more just like this in a table. But you can see in a T account format how these journal entries, as they're impacting with debits and credits, retained earnings, you arrive basically at the same place. So the 25 is shown there, the 130 is shown there, and then, and just for the heck of it, see, we would have accounting revenue. Let me clear all these out. So remember, we would initially have a $500 credit balance in accounting revenue, and then we're debiting accounting revenue. And I'm just gonna create a couple more T accounts so you can kind of follow along. So we debited the accounting revenue like that. And then if we said this was income summary, we are crediting income summary. So those are the two entries there. Just kind of highlight these. Okay. And then I'm just going to make one. This is all of our expenses. Now, in reality, each expense account would have its own T account, but just for the sake of making this a little cleaner and easier to see, we would have 300. So we'd have 20, 100. Oop, I got to add a little extra. So 2100, 250, which corresponds to all these different expenses. And remember, in reality, each of these expense accounts have their own T account, but I'm just putting them all into one so you can see the representation of that. And they would have debits as normal balances increases throughout the month. And with our closing entry now, we go, okay, we're going to close that out because that's 370. Then we've got 370 credit to close it out. And then again, this goes into the income summary for a debit. So that's the same journal entry there, this and this, and this and this. Those are the two closing entries. And so now we can kind of see, okay, the income summary, now with debits and credits, if we subtract, take the larger minus the smaller, we have 130 left in the income summary account. And we want to close that into retained earnings. And so that's where we get our debit to the income summary. Let's do it in blue. And the other side, so that's the debit. The credit will be right here. We already kind of showed that. So credit, debit, debit, credit. And that's this journal entry right here. And then the last one, just for the heck of showing it, I'll pull that one in too. Dividends. Let me clear all this out. Okay, and then initially we would have had $25 in dividends, which has a debit normal balance from the original entries posted. And then in our closing entry for dividends, we're going to credit the dividends account to reduce it to 0. And we're going to debit retained earnings for the other side of that journal entry. So retained earnings debit, is that and that. And then I'm just going to color code these so you can kind of match them up if you're curious. So that's the journal entry there. This is the journal entry. Oop. I think that was the same color. I don't know, whatever that color is. That's the one I was trying to go for. Maybe it's one more darker. Too dark. Okay, anyway. So that's the entry there to the income summary. And the expenses, basically, it's the sum of all those. So it's not, the 370 is there. I guess maybe it would be more matched up if I did it like this. If I did a 20, 100, 250. And so those all add up to the 370. So all the individual credits sum up to 370. And so the debit for all those is to the income summary, as you can see. And then, back to the 500 we originally had. So now what you can see is there's no ending balance in revenue. There's no ending balance in the income summary. There's no ending balance in dividends. And there's no ending balance in expenses. Because our debits equal our credits, basically that's saying like plus a certain amount minus the same amount. And when you add something, plus 10 minus 10, you get 0, right? So that's the whole idea, is that now these are all closed. And basically we aggregated them all together, closed them out, and moved them into retained earnings. And you can see how that kind of looks in report format. And then also in the GL, retained earnings now has a $285 ending balance. And that goes on the balance sheet and rolls forward to the next month. All these other temporary accounts are now zeroed out and ready to be recorded into for the next month. So, all right. Well, that does it for problem 3.2, second part. So hopefully that was helpful, helped you understand closing entries a little bit better, hopefully as well. And I'll see you in the next.